What does it really take to raise money from family offices? Stick around to hear directly from DJ Van Keuren, founder of the Family Office Real Estate Institute, next. Raising money from family offices is the ultimate goal for many fund managers and sponsors of real estate syndications. But what are the best strategies for raising money from family offices? What makes them tick? That'll be the topic of today's episode. Welcome, everybody, to Fund Playbook, a show that's all about how to launch and raise capital for your very own private fund or real estate syndication. We go live Thursdays at 3 p.m. Eastern Time. Just hit that subscribe button to follow the show. I'm Jimmy Atkinson, and I'm joined today by a special guest, DJ Van Keuren, Executive Director of the Family Office Real Estate Institute. DJ, what is a family office anyway? What do we mean when we say that?
Well, a family office, the best explanation that I can provide for that is it's the business of the family, not the family business. So it's typically, there's a big exit that happens to for a family, maybe a sale of a company. And now they need to figure out not just how to invest, but how to plan so that that money can continue on for future generations. And so, our definition is 250 million is a family office, but, others say 100 million. At the end of the day, it's still passing along your values as well as your capital to future gens.
Yeah, oftentimes intergenerational wealth, and also oftentimes a very long investment horizon, thinking not just for the next 5 years, the next 10 years, or until I retire, but how do I make this money last for multiple generations and pass it on to my heirs and make sure that they have enough money to pass on to their heirs? A very interesting group of people, these family office executives who manage a lot of the capital for these family offices, as well as multifamily office executives. And then the families themselves, we'll be talking today about what's the best way to get in front of a family office or a family office executive, and what's the best way to raise capital from them. But first, DJ, tell us a little bit about your background. What brings you here to the show, and how did you get started with the Family Office Real Estate Institute?
So I was an advisor in the 90s. I then went to Asia for a number of years and back to grad school. And then I was in New York City, started working with a number of, the institutions like Goldman, Blackstone. Moved out to Denver, and I literally fell into the family office space about 10 years ago. And I worked for my first billionaire. And initially, we were putting out 100 million to oil and gas. We had 3 people actively trading equities. We had 7 solar parks. And after being there for a while, I got headhunted by the Heyman family of Giorgio Perfume, Giorgio Beverly Hills, working directly for them. Created a boutique office brand strategy, and ended up getting it stabilized, leaving, and then started doing some work with one of the owners of a Major League Baseball team, and then continued to meet people in the industry, both families and industry professionals as well. So, I tell my daughter, who knew what she wanted to do when she was 10, I was like, well, I figured out what I wanted to do when I was 45. So I love real estate, and I love the family office space.
I love that. There's hope for all of us if we haven't turned 45 yet. It's good to know. And what differentiates a family office from an institutional investor? Sometimes I feel like some people use those terms interchangeably. Basically, they just mean it to mean somebody or some entity with a lot of wealth that they definitely want to try to raise capital from. But what distinguishes those two different classes of investors from each other?
Well, let's go back and look at the 4 different areas that you can raise capital from, right?
Sure.
Well, now, and we won't include online. I mean, that's happened over the years, right? And that's typically your retail investors. But you have your retail investor, which is working with a local advisor. That's one. Personal money. People, the majority of the people probably that are being managed is under $1 million per family. They might have a couple that have a couple million, but it's financial planning. You then have the registered investment advisors, And those are people that work with larger pocketbooks, larger families. They charge on a flat percentage typically, or they might charge, have a monthly retainer for advice. And then you have the institutions like the Blackstones and the Goldman Sachs. And then you also have your family offices. A lot of people mention that family offices are, like institutions. And actually, they're like the retail investor. They're not like the institutions. And the reason I say that is because the people that are making decisions at the institutions are typically, been out of grad school for a number of years. They're very analytical, making those decisions, but they're investing on behalf of pension plans, right? Or retirement programs or insurance companies. And it's not their money. It's not their money, and they have to put it out. If they have a certain amount that's been raised, they got to get it out the door, but it's not their money. Families, on the other hand, like the retail investors, that's their money. And they're not, probably maybe 99% of them will not have that same opportunity to create that kind of wealth again. Yeah. When you look on a global basis, it's probably around 15,000, and that number's continuing to increase just because it has been a word that's been coming more to the forefront over the number of years. And, here in the US, probably a little over 40% of the families are here in the States. And so it's quite a number of, and that's not even including the people that are ultra high net worth, the 50 to 100 million or 150 million. I mean, if you go down to like parts of Houston, you have thousands of people that are worth 100 million, right?
Sure.
And so that's not including them as well. So it's growing. It's a market that's definitely growing.
Yeah, of course. And just getting back to the point I was making a moment ago before I interrupt myself with I want to know how many of these entities there are. They've already made their wealth. So what are their investment goals typically? Are they really just interested in capital preservation, not losing money? Do they want to be a little bit more aggressive, especially given the fact they have a long investment horizon? They can ride cycles, multiple cycles for multiple generations. What makes them tick? What overall is the investment philosophy of your average family office?
It's the same thing that I was told for every family that I've worked with or for. Don't lose money, don't lose money, don't lose money. So it's definitely more conservative. In fact, a lot of people, and Jimmy, I know that you like to have it interactive too. So if there's anybody that ever wants questions as we're going through this, just ask, and we can make it a conversation. But the average, this is where I'd say, what do you think the average return on a portfolio is? So I'm going to ask you, because I can't ask everybody else. What do you think the family office's average return? This is across all families on their full portfolio.
Average return on a full portfolio, and you said they're conservative. I'm going to say 6%.
You're very close. It's 7%.
Okay.
And a lot of people are very surprised, when you look at that, because that's much smaller than you'd think it would be. At least that's the way I was initially, because I thought, they're probably making 10, 12%.
I sandbagged it on purpose because I knew where you were going. So I screwed up your example there, but I would think, yeah, probably most people guess 10 or 12 or something like that.
Yeah. So, but yeah, it's 7%. And that's been verified by talking to numerous families over the years too.
That's interesting. So bearing all that in mind, we know what a family office is now. We kind of know a little bit what makes them tick. Look, they've already earned their wealth. They've already had a substantial transaction, or they've been accruing wealth over a number of years, maybe dating back several generations, sometimes to the 1800s or the 1700s even. Of course, there's a lot of newer families who've made their money in the 20th century, even the 21st century. But their investment strategy, conservative, average return 7%. Now, if I have a real estate syndication, or if I'm raising money for a real estate fund, or maybe it's a VC fund or some other type of PE fund, and I want to get in front of family offices and present my investment to them, what should I be considering? I should be considering what makes them tick and what their goals are, but how do I present myself to a family office? What advice would you give to me?
Well, that's a really good question. And my first comment is the first thing you should be thinking about is who is this, and to learn about them. It's not your deal. Everybody walks in, a majority of people, they see this big check on their forehead, and they think they're going to write a big check and stuff. And it's all about relationships. And so it's really more talking about initially what's being involved here, right? What generation are you in? Where was the wealth created? How many family members are there as you go down the line? Because the more you find out and you're talking about this, the more you're going to get an idea of what the dynamics are within that family or how things are going, as a whole. I mean, yeah, you can get to the point, how much you're allocating to real estate and what type of things do you look for. But first you have to come from it, just like you're, meeting somebody new for the first time. Jimmy, when we met, if we met at a restaurant or something and sat down or at an event, I don't say to you, hey, do you want to invest in this? Right? I'm just like, hi, I'm DJ. What do you do? And that's exactly the manner that should be taken when working with families. And the best way to find families are through referrals, because they don't put signs on the door that says we're a family office. And at least not the big families as a whole. And so it's getting to know who they are. And it might take you 2 weeks to get a check. It could take you 7 years, which is similar to an institution where it takes time.
Yeah, I like to caution emerging fund managers and emerging sponsors of real estate syndications who are trying to raise capital, particularly if it's a first-time capital raise, or maybe they're still early enough in their careers as capital raisers. Capital raising is all about relationships. I think that's true of any type of investor, whether it's a smaller Main Street type accredited high net worth investor with a few $1,000,000, whether it's a huge institution like JP Morgan Chase, whether it's a family office like some of the family offices in your group and that you've consulted over the years, DJ, with a few $100 million. It's all about developing a relationship. You're exactly right. You don't sit down with somebody and ask them, hey, do you want to invest?
I've never thought about that before, but it's true, right? If you just meet somebody, you don't start asking them if they have money and if they want to invest in a deal that you have.
I liken it to meeting a girl at a social event, maybe at a party or at a bar. You don't go right up to her and say, hey, do you want to get married? Right? No, nobody would do that.
That's 100%. And the other, there's a big misnomer too. People think, okay, family offices, they have all this money, they're going to write me a 15, 20, $50 million check. Can that happen? It can, but the reality is you'll probably get 200,000 or 2 million, but the next check could be 2 million and 10 million, because they want to first feel out the relationship. And so they're going to test it out with a lower amount. And a lot of people get discouraged because they see these lower checks that might come in if they do get money from a family, but that's part of the process. On the other side, not only are bigger checks, but then they'll start telling other families as well.
Good. Did just want to repeat what you said a few moments ago, DJ. We're live right now on X, on YouTube, on LinkedIn. We've got a pretty good audience in the crowd today. If anybody has a question for myself or for our expert guest, DJ Van Keuren, don't be shy. Feel free. Fire away those questions. We'll get to as many of them as we can a little bit later in the episode today. So keep those questions coming in. DJ, getting back to, what makes a family office tick. And we're talking about, approaching them for the first time, you mentioned the best way to meet family offices is through a referral. But sometimes maybe you don't have that network, or your network doesn't have connections to family offices. If I'm just starting out, I've got a new syndication, or heck, maybe I'm not starting out. Maybe I have a track record, and maybe I'm doing my 18th deal or whatever, but I still haven't really cracked into the family office world yet. What's my best way to get the foot in the door? Where are some of the best places to meet family offices and gain access to those relationships?
The way I built my network was simply going to conferences, and you're going to have a lot of sponsors there, and you really, really have to work the room. I mean, I would be exhausted at the end of a conference because I would literally have to pick out who the people are that are real. Because sometimes it might only be a handful of families that are actually there, and everybody else is a sponsor or looking for families. So you can't just go and think they're all going to show up, or you're going to meet all these families. You actually need to put effort in to figure out who that is. The other thing too is that you want to find out about their family office, because over the last 3 years, everybody's become a family office. If you're raising money, you're not a family office. If it's a business, real estate's a good example. It's like, well, it's a family business, and we've been doing all these deals forever, and we're a family office. Well, there's a couple ways that you delineate that, and one of them is a checkbook that's going to be invested coming from a personal checkbook or a business checkbook. If it's a personal checkbook, then that's probably from the family's money, right? It's just like Bill Gates isn't going to invest something, buy one of his hotels that he owns, Four Seasons, with Microsoft's money. He's going to write his own check, right, and work on his wealth. So that's one thing. Secondly, if they're raising money, I wouldn't classify them as a family office. It's okay if that's happening, but the reality is it's the business, and it goes back to what I said before, which is the best explanation I've ever heard, which is it's not the family business; it's the business of the family. And so that needs to be totally separated between the two. And who are you representing? Because the reality is that person that is representing the business 99% of the time is not the person that's the CIO or CFO of the family office. Does it happen? Sure, sometimes, if they only use their money to invest. But you really need to work the room and then talk to people and ask them, where was the wealth created, and see what they say. And so what are you guys working on? Well, it was created in real estate. Oh, well, what are you guys doing? Well, we're in the process of raising this fund for, okay, I better speed this up and look for the next person to see if they're a real family.
Because if maybe they are a real family office, but if they're raising money for a fund, they're probably not looking to deploy capital into somebody else's syndication, right?
Well, that's the thing. If they're raising money, they're not. It's a business that's raising money. Now, that family could be investing into that business.
I see what you're saying. Yeah.
Yeah. But it's not, for example, for your personal investments, right, with you and your family, whatever you invest into, are you ever out raising money for your personal investment accounts? No. Right? You're not. So that's the same, maybe it's for a business. Okay. But that's separate from your personal finance.
Okay. I see what you're saying now. Okay. So you got to work the room. You got to, and you've given us some good examples of some filtering questions to use on determining if somebody's actually a family office or not. Because that's a good point, DJ, that you make. Because I think a lot of people use the term family office loosely, including family offices themselves, or people who have or who are a wing of a family office, but may not actually represent the family office, which is the family itself, right? They're more represent the business of the family.
Yeah. So we have at the Family Office Real Estate Institute, we have 3 events a year where we actually are interacting with families. 2 of them are investment forums, which are specifically there for families to look at deals. And then you have the annual conference, which we're fortunate to have you speaking at again, that's coming up. And I personally screen every single one. And I'll tell you, we turn probably down about 35% of the people that say they're a family office that does not qualify. As soon as they check on that box that they're raising money, our philosophy is that there are sponsors that come, and it's not fair for them to pay money and you don't raise money or to make relationships, but yet you're not paying money, right?
Right.
So, but yeah, I'd say about 35% of the people we don't allow.
You have to turn away.
Each different sector. Yep.
Well, I feel fortunate that you let me sneak in as a speaker then, so I appreciate that. I'm looking forward to that one.
Always a back door, so.
Yeah. Before we move on, can you tell us a little bit more about that conference? This is the annual Family Office Real Estate Institute conference. It's at the University of Denver in Denver, Colorado. Can you give us the dates and what we're going to cover at that event?
It's 16th and 17th. And
that's of October, right?
September.
Excuse me. September 16 and 17, 2025. Okay, go on.
Yep. And we do it every year at the University of Denver in September. And a lot of conferences that people attend, there's what I call pay to play. So you're paying as a sponsor, and that allows you to be up on stage. And I personally think that that's self-serving. You're not really giving any value to the people in the crowd. So we don't have any of the sponsors unless they fit into what our agenda is and our topics. They're not going to be up front. And we'll go in and, we'll interview different families. What's been interesting over the last couple of years is that other families in the audience start asking questions, which is cool. So it's quite interactive. It's small. You just have about 40 families that are there. And then we'll have, 70% of it will be real estate related or economic related, and 30% we go into family issues, governance, family councils, investment policy statements. We do the same thing at the executive education classes at the University of Denver or online because of how we started this whole conversation. I've been fortunate to work for a number of families, so I understand the intricacies of families. And so I'm able to sympathize on many fronts, or understand why this isn't happening or that's not happening. But I purposely put that together, one, because families don't have their act together as much as you think they do or would. And second, any sponsor that's there, they need to understand the other things that families are dealing with. It's not just the checkbook.
There's a lot more to it than the purse strings and the money in the checking account. That's part of it, obviously, but there's a whole lot more that goes on behind the scenes, and especially when other family members get involved with the wealth, and then you start talking about second generation, third generation. How many people does that end up being? That could sometimes be dozens of people now with their hands in the pot, and if they don't have proper governance, these are a lot of the issues you cover at the conference. I don't want to give it all away, but it is interesting. It was interesting for me to learn about that. Last year was my first year going to your conference. I learned so much about, wow, I had no idea this world of family offices and everything that goes into being a functional, successful family office. It was incredible.
I mean, let's give you a specific idea, because 70% of families' wealth is gone by the second generation and 90% is gone by the third generation. And I could tell you stories about families that had billions that lost it all. I personally, experienced somebody that told me they lost 80% of their family's net worth, which was $800 million. And that was real estate related, actually. But what I like to explain is look, you're going to have a fight at some point in time with either your parents, grandparents, your brother, your sisters, your sibling, your significant other, your wife, your spouse, your kids, right? At some point in time. Now start adding a bunch of zeros to that, and it starts getting much more difficult to deal with.
Oh yeah.
And then the other thing too is let's say that you had, a matriarch dies, and one of the people that was part of the portfolio is 50 years old. And now all of a sudden somebody comes in that's 30. Well, there's two different thought processes. That person at 30 is like, let's get into AI and let's get into tech and all this other stuff. Where that 50-year-old is like, no, let's just keep it steady, you know? And so now internally, if you're trying to get a deal through, well, who's part of that decision-making process? Because there's two totally different, people that might be influencing what's happened if they don't have their own CIO and they have 100% control of making the decisions, which isn't that often.
Sure. So, okay, so we've talked about some of the complexity that goes on behind the scenes at some family offices from time to time. I want to revisit the topic of raising money from families and some expectations. But first, actually, we did get in a question from the audience. I want to just show it up on the screen right now. I don't know if you know the answer to this one, DJ. This one might be a little esoteric, but I'll read it anyway. Maybe somebody else in the audience will know. He asks, this is from Philosopher Sar, who asks, how do you navigate the foreign regulatory environment? Raising in EU requires NPPR registration in each individual country. Same with most of Asia and Middle East. And pre-marketing is highly limited. He goes on to say, setting up a feeder/host fund is costly and risky, given you can't conduct pre-marketing to gauge interest. So I'm not an expert in EU regulations. I don't know if you have anything to add to this, DJ, but I just wanted to get that on the screen in case it piqued anyone else's interest.
Yeah, so a couple of things. One, the first thing I would do is to try to find a seasoned attorney that has the experience and understands. That's if you need help from that perspective. I would start reading a lot. Like if I didn't understand about feeder funds or offshore accounts or whatever, the only reason I know about it is because I just kept researching and reading so that I would have an understanding, plus talking to the professionals. I don't, there's what they call a red herring here in the States, and you're not precluded from getting indications of interest. They're non-binding indications of interest, but I would see if you could do that overseas in those markets, because then it's like, I'm talking about it and how much do you want me to set aside for you type of a deal. It doesn't mean that they're going to invest any or that full amount, right? The majority of the time they do, but that's what I would do, is to get indications of interest, because what else happens when you do that is you may find out that you need to tweak some of the structure that you put together for that fund. And the people that are international, the investors, they already know about these offshore funds. They know about feeder funds. Because they have to deal with it all the time.
Good advice there, DJ. Yeah, thank you for that. And thanks for the question. Anybody else has a question, feel free to submit it through the live chat. We'll get to as many of those as we can. Getting back to raising money from family offices, you mentioned if you're a sponsor, you probably get really big eyes when you see a family office who's starting to engage with you. You start thinking, man, this family office is worth 250 million, a billion, 2 billion. You might start thinking, man, I might get the whole, I might be able to get a huge slug from this family. Maybe not, I can close the equity raise. I'm raising $15-30 million, whatever it is. They might just fund the whole thing. And then they end up giving you 200,000 or a million or 2 million. But to your point, if you can succeed with that initial syndication, they're going to come back, hopefully, for a bigger chunk next time. When they come back for a bigger chunk next time, maybe they want to make more of a commitment. Maybe they want to put in 5 or 10 or $15 million. What do they expect in return? Are they an LP like any other LP on the cap table, or do they sometimes want co-GP or some other type of control? What are some terms that some family offices can command if they come in with sizable chunks of equity?
And I do want to, we can go over the 5 different types of real estate, family office real estate investors, because I think that's important. There are families that have to put out a minimum of $20 million. That's the Michael Bloombergs, the Bill Gates, the Ross Perot families of the world, right? But they hire institutional people to help manage that money. So now that's a pseudo institutional knowledge, but it's family office type money. But back to your question, which was, you might have to rephrase that for me again.
Well, if a family office comes in with a substantial
Oh,
amount
what
of
type of rights
equity,
and stuff?
what type of rights or terms are they looking for typically?
It definitely determines on the check size. They're very fee avoidant, but they don't want you to not make enough money to run the business.
Right.
So they totally get that. They like it that you're incentivized. So they're in favor of that. Um, there are families that they do have some in-house expertise, so they can put some of those controls in, but those are going to be the big checks for sure that come in. But typically, they're LPs, and as I mentioned before, I would say the majority of families, they don't even have an investment policy statement or investment policy strategy for how they're going to allocate, where they're going to allocate, how much they're going to allocate. I mean, we know percentages of what families do from research, but that still varies family by family. But if you're going after somebody that's a real estate family, I mean, obviously there could be times that they want to be involved to some degree, but usually those real estate families that invest are investing into property types that they don't have expertise in.
Okay. So you mentioned a minute ago the 5 different types of family offices or real estate family office investors. I forget how you termed it. Can you walk us through those 5?
Sure. So you have the Michael Dells of the world, like I said, the Bloombergs. They're going to hire institutional people and it's professionally ran to make decisions on their money. Minimum that they have to put out is about 20 million. They will do joint ventures. They will do, multiple deals. They will do funds. So because they have so much money, if they're sitting on billions of dollars, they got to get it out the door. And so they are okay with going into funds. The next type of family that you have are families that just build up their own real estate for themselves. So maybe they hire property management to oversee all their properties. So you could end up having, they're building up their own. They'll pass it out maybe onto the gen, but they're going to be hands-on with their own properties. They might invest in some other deals outside, but the majority are their own assets. The next type are families that didn't create their wealth in real estate, and they like to do direct deals. Based upon our annual survey, about 70% of the families want to go direct, and that's because they have visibility into what they're investing into, and they'll do individual deals, one-off deals. They will look at funds, but they mainly want to go and invest directly with an operator and not go through a fund for the most part. The next type of family is one that they have no infrastructure in place whatsoever. And so they actually primarily do funds. And because they don't have the expertise of where to invest. I mean, the one thing you have to realize, and I made this mistake when I started in a business, is I was thinking, well, these people are very intelligent. They're smart. They're successful. They know everything. The reality is they spent the last 40 years in chemicals, or maybe they were doing podcasts, right? And now they have all this money, and they don't understand real estate, hedge funds, venture capital, private equity. People spend their whole life not only in just VC, but healthcare VC, and not just healthcare VC, but middle market healthcare VC, right? And so that's another thing that's very important, is don't assume that they're understanding everything you're talking about. In fact, with OZ investors, people thought families would be flocking, and it's all simply because of not understanding the OZ, right?
Yeah.
The first year, it wasn't in place. They were like, what's going on? And even if you ask today, they don't understand it. And so it goes back to educating, taking the time.
Yeah, for sure. We got a question in from the audience. This one comes from Austin on LinkedIn. He asks, how do family offices typically run due diligence on alternative strategies like opportunity zones? Do they rely more on internal teams or outside consultants? And that probably boils down to what type of family office they are and what their expertise is. But DJ, what would be your answer to that question?
Yeah, I mean, if they have some type of infrastructure in place, typically you don't hire an internal CIO till you're about 750 million.
Hmm.
And that's what the numbers come out with. And that's where those multifamily offices come into play and can help from that. But even if they didn't have, even if they did have a CIO there, they will engage, an accountant, an attorney. They'll go back to their experts, professional experts, and ask them certain questions about understanding the OZ itself. Does this make sense? But from an analysis perspective, it's typically done in house, whether they have that knowledge or not. And if they didn't create their wealth in real estate, it's probably very limited knowledge. In fact, we had first class we had at the University of Denver. We had 3 billionaire families represented, and they're asking about cap rates. What's a cap rate? And so, but it's usually done internally. Typically, I would say for the most part, it's done internally.
That's very telling, isn't it? You've got billionaires coming and asking what a cap rate is. I mean, it just goes to show you, like, I don't know anything about chemicals or biotech or wherever they might have made their wealth, right? And you shouldn't assume that they necessarily know anything about investing or real estate. That is a big lesson, I think, you have to learn. So sometimes you need to slow things down. Certainly if they have a CIO who's more of an institutional type of person, you'll be able to speak with that person and they'll be fluent, right?
Yes and no, but here's the thing. 95% of the people that work for a family fell into the space, right? So you get all this money. And my second uncle was the CEO of Albertsons, and he ended up retiring with 100 or something million, which is all public. And he told me who his person that he brought along, and I didn't understand it at the time. This is before I worked for families, but you get all this money, $300-400 million. The first thing is who do I trust? Maybe it's the accountant, maybe it's your financial planner, maybe it's your insurance agent, maybe it's your neighbor who's ran multiple businesses. Well, guess what? That accountant, that neighbor, they don't understand venture capital, private equity, real estate, right?
Yeah.
And they don't understand the details into every one, and we go back into it again. So once again, you can't make that assumption that regardless of where they came from, that they know all of this. And that is, like I said, I've made that mistake the first 3 months, but I think that's another misconception.
Yeah, that's fascinating. I hadn't thought about that, but that
makes sense, right?
does add up. It does make sense. Yeah.
Who do I trust?
Yeah.
Who do I trust?
That's really
and
interesting.
Also, once somebody hits about 100 million, they start moving away from Goldman Sachs, the Merrill Lynch's of the world, because of the fees.
Yeah.
And because of
once you start handing over $1 million in fee every year, right?
Well, not only that, but they're also, selling their own funds, not putting it into outside. So not necessarily. So that's when people start looking and they start just, cleaning house for the most part.
Sure. That makes sense. All right. Well, DJ, we've got just a few minutes left before I want to wind things down, just to kind of bring it all back together. Title of the episode: How to Raise Money from Family Offices. Let's hone in on that topic here for the last few minutes, like we did at the top of the show. If you had to start all over, you're raising capital from family offices from scratch, is there anything you would do differently, or any advice for folks who are in that situation when it comes to how do you stand out in a noisy market where if you're a family office, you're probably getting pitch deals all the time?
I tell people what I used to do, because one of the families we did have, we were looking for other families to co-invest with us. And what I would do is I'd meet them like at an event and just get to know them. And then I might, I'll get their information. I'll give them my information. I send them a thank you card or something. And then, 5-6 months down the road, and this is my pitch, I pick up hey, how you doing? What's going on? Hey, we're working on this deal. Do you want to take a look at it? And if they say yes, which the majority of the time they will, then the door's open. And now it's like, okay, let's really get into this thing. And so it's a matter of it takes a little bit longer to do that, and then start trying to get referrals, which is in any sales capacity, and make sure that if you do be wary of some of the lists. There are legit families on there, but then there's also not. And be aware of somebody that says they're a family office, but they're really not a family office. They're actually trying to raise money themselves for what they're doing.
Good advice.
And they're just using that word. And go to conferences is probably one of the easiest ways. And the real families typically go to the conferences where they're paying to go. So like an IPI or a Fox, I mean, they're paying $20,000 a year to be a member. Well, they're going to go, and you'll get the real families.
And that's a great filter to gatekeep the real families from maybe the people who are not a true family office. I got another question in here really quick. I can address this one from a user on YouTube called Happy Go Lucky. I like that account name. This person asks, what do family offices do if the OZ project, I assume an OZ project that they are invested in, has gone down and is worthless, and now they have to pay taxes? So I'm assuming that this person is referring to, with an opportunity zone investment, if you made an investment into a qualified opportunity fund, you get to defer that gain amount that you rolled over until December 31, 2026, at which point you recognize that gain on your 2026 tax return and you owe tax on that amount. But what is the key thing here is, for username Happy Go Lucky, the amount of gain that you recognize on 12/31/26, whether you're a family office or not, is limited by the fair market value of the OZ investment on that date. So if you look at the statute, it's defined as the lesser of the amount of gain that you initially rolled over, or the fair market value of the OZ investment. So if the investment has gone down and it is truly worthless, then that family office or whoever it is will not owe any tax on that date, or at least a substantially reduced amount of money. So that's something that we're just starting to talk about on my other platform at opportunityzones.com, because we are getting closer to that deferral date now, DJ. And I know that that's going to impact a lot of family offices who made investments into Opportunity Zone projects in the last several years. One last topic I wanted to cover with you, DJ, before I let you go today. I want you to gaze into your crystal ball. What's your forecast for family office capital deployment over the next 3 to 5 years, let's say?
Well, we're going to go into a recession next year. And I've been saying that for 6 or 7 years.
You have.
And everything's still pointing in that direction.
Yep.
And we're starting to see a lot of the discounts on properties. In fact, I was just talking to one of our partners the other day, and this one group's going to walk away from $100 million. I mean, it's real money because they don't want the guarantees that they have, and they just can't pay the debt, right? Families are still, there's been a lot of capital calls that have been coming that never happened 10 years ago because everything just went up.
Yeah.
So there's definitely a hesitancy. And so families 3 to 5 years, during the recession, the last recession, families waited until things started coming out and coming up and improving. Then they started investing. So they really missed out on the downturn at the bottom. And I didn't think that would happen again from learning from it, but I can tell you that it's happening again. So I would say 3 years from now, they start deploying capital again. And then we come out of it, and then they continue to deploy, but it'll be a lot less over the next 3 years.
Well, we'll see how that all plays out. I've been warning about an impending recession for several years now. I think I may have jumped the gun a little bit, but you've been sticking with 2026, I think, as the date that you had anticipated a recession for many years now, in the face of some criticism as well, when it looked certain that we were going to dive into a recession in 2021 or 2022 when they started jacking up the interest rates coming out of the COVID crisis. But we never did. We never did enter an official recession during that period of time. I think we had
The only thing
we had a mini recession in 2020 when everything shut down, but we quickly rebounded from that.
that was a black swan.
Yeah, I think it was only 2 consecutive quarters of negative GDP growth, and so technically it was a recession, but it was.
But we didn't expect that to happen. The
Correct.
only thing I will say is literally the Trump card, no pun intended, because if he tries to control the Fed, which he is, and he's able to influence what's going to happen. Long term, I think it'll definitely hurt the economy. Short term, he really lowers interest rates. People can now refinance. They're now not in trouble like they are right now because there's $4.5 billion of loans coming due over the next 3-4 years.
Yeah, a big wall of maturities that the capital markets are staring at right now could pose some serious problems. Well, we'll see how it all unfolds. DJ, thanks for joining me today. I appreciate it. For anybody new to the show, we go live Thursdays at 3 p.m. Eastern time. Just hit that subscribe button on YouTube and you'll get notified of all of our upcoming live streams. If you enjoyed today's episode, hit the like button, give us a thumbs up. By the way, for those of you who are audio listeners, Fund Playbook is now also available on Apple Podcasts and Spotify. Just search for Fund Playbook on the app of your choice. Or you can also visit fundplaybook.com and just click on the Apple or Spotify button. Thanks for watching and listening. We'll be back with another episode very soon. Thanks, DJ.
Thanks, Jimmy.